Hi, I'm Max Keiser. Welcome to the Keiser Report. Round Eye has gone crazy. According to Mrs. Wang, Americans are dumping paper gold and diving into the Dow. Europeans are lining up for Cypriot haircuts. The ECB is ready for negative deposit rates. The Fed vows to maintain its $85 billion in welfare spending for Wall Street. And the Bank of Japan is flying the yen into the ground. And Israel, Australia, and India pledge to follow. Great leaps forward are being made daily in central bank insanity, while the real housewives of China are backing up the truck. Yes, Mrs. Wang is fighting the Fed and the ECB and the Bank of Japan, too. Because, of course, Mrs. Wang has seen this movie before. It was called The Great Leap Forward, and it brought about what is known as the 3 years of natural disasters, or, if you prefer, the 3 years of difficulty, in which between 15 million and 43 million Chinese died during the Great Famine, brought about partly by central planning gone completely frickin' amok. Mrs. Wang knows this. That's why she's buying gold. Stacy.
Yes, she is. And of course, she's seen the central planning and how it goes. It caused only 3 years of disaster, of natural disaster. We have, this is our 4th or 5th year of man-made disaster. The Great Leap Forward, Mao Zedong led the campaign based on the theory of productive forces. And he intensified it after being informed of the impending disaster from grain shortages. So he saw that it was making it worse, and he doubled down, just like what we see across Europe, across America, certainly in Japan. They're doubling down on a disastrous policy. Euro plummets as Draghi says ECB is open-minded about negative rates. European Central Bank President Mario Draghi has announced that the ECB is technically ready for negative interest rates. As Draghi said that, the ECB had an open mind. The euro plummeted against the dollar, and you can see that in the chart here.
Mao, 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 and Mrs. Wang. They got a real bad thing going. Mao Zedong and central planning doesn't work. Ben Bernanke is the Mao of central banking. He's central planning. They're causing natural disasters because, of course, the cost of doing what companies like Exxon do are never reflected on the true income statement or balance sheet of that company, so they're free to commit economic jihad and environmental jihad.
And of course, when the part of the Great Leap Forward was the collectivization of the agricultural lands, and you weren't allowed to own private property. So private farming was prohibited, and those engaged in it were labeled as counter-revolutionaries and persecuted. In the same day and age today, when you try to protect yourself by buying gold, for example, to protect yourself from the ravages of collectivization of monetary policy, because let's face it, they're working together. The Fed is working with the ECB, working with the Bank of Japan, working with the Bank of Israel, working with the Bank of Australia and Canada to collectivize monetary policy around the world.
Right, they're collectivizing monetary policy, and then they're asking the individuals to sacrifice, like in Cypriot. They have to give over their savings for the good of the collective. That's being managed by ECB, Mario Draghi, Ben Bernanke, Mark Carney coming over here to the Bank of England. And people are buying gold to protect themselves against the collectivism of these central planners, these central government authorities, these central bankers. And the result is quite stunning in that as you point out, Mao, when faced with destruction, doubled down. He doubled down, Mao did. Mrs. Wang, of course, saw that Mao, or bureaucrats, when faced with catastrophe, instead of having the humility to say, man, I'm a jerk, and we got to change. Same thing with Federal Reserve Ben Bernanke or Barack Obama. Instead of having the humility of just facing the public and saying, I fricked up, I'm an idiot, we got to change course. They're doubling down on their insanity, whether it's a foreign policy or whether it's domestic policy, to print $85 billion a month. And quantitative easing in America, it'll be 160 billion soon, and 360, and $1 trillion. It's just no limit to the insanity, the doubling down of their collectivism. And to pay for it, they're going house to house, they're confiscating wealth, they're taking people's bank accounts, and it's an atrocity.
Yes, it was grain shortages which caused them to double down in China, Mao Zedong in 1958. Well, it's shortage of liquidity that is causing them to double down in this thing. But the fact is, of course, it's being hoarded by a few guys, and of the likes of Blythe Masters, who's now under investigation, of course.
Well, let me just cut in for a second. I mean, look what's happening in Ireland. What I call, and we've called on this show, interest rate apartheid. The interest rates for the collectivists, overlords, their interest rates are close to zero for when they borrow money to speculate and drive asset prices to all-time highs. But the mortgage rates in Ireland are now being doubled. So if you're not part of the Goldman Sachs coterie of insiders, you have interest rate apartheid. Okay, your interest rates are being jacked higher. But if you're on the other side of that apartheid wall of interest rates, your interest rates are close to zero. That's the new discriminatory defining wall. It's not the apartheid wall in, let's say, Palestine and Israel. That's not the big one. The big one is the interest rate apartheid wall between the Goldman Sachs and the rest of the world.
Well, in Ireland, actually, since you bring that up, the peasants there are very loyal and have shown great allegiance to the party, in this case, the central bankers, because it's just emerged that the 64 or 84 billion euros in bailout, well, who was bailed out? The unsecured bondholders of Anglo-Irish, for example. Who was that? Well, Bill Gates owned 27 million euros, but you go there and the peasants want to show loyalty, that it is their obligation to serve Bill Gates and give him his money back. He wouldn't have noticed the 27 million missing, but these Irish people feel obliged to pay for their central banking masters. But remember, when gold crashed, when the price of gold crashed, because remember, it's disloyalty. Gold was disloyal to the revolution, to the central banking revolution. And remember, we covered the fact that Joe Wiesenthal at Business Insider said that it was great news that gold collapsed because the collapse in gold is not about gold, but about vindication for a large corpus of belief in economic research, which was largely panned out. It's great that our economic elites know what they're talking about and have the tools at their disposal to address crises without creating some new catastrophe. So he said physical buying alone would not change the game. And to support that argument, he showed GLD that they had sold $16.6 billion year to date. So the first 4 months of the year, Western investors sold off $16.6 billion. So I'm going to go to this next headline. Housewives gold rush keeps prices from falling. According to the Voice of China radio program, one of the year's most popular phrases may be Chinese housewives, as a major force which reportedly spent 100 billion yuan, or $16 billion, over the past 2 weeks, purchasing 300 tons of gold and thus helping to sustain gold prices at $1,468 an ounce. Western investors over 4 months sold $16.6 billion, or 271 tons.
All right, well, it's a form of punishment whenever the physical buyer in the shop in Asia, the Middle East, or even in America or in Australia, when they're out there buying physical gold and they're pressuring these bullion banks and they're pressuring the fractional reserve terrorists, then what happens is they impose a collective punishment of crashing the gold market with their paper short sales. So this is, again, part of the interest rate apartheid. People who want to escape the ghetto of 0% interest rates buy physical gold, and if the price of gold starts inching higher, because, of course, it's a limited supply, then the paper barons and the collectivists, they smash the price of gold as a punishment, as a price tag, for having the temerity to be free of the paper tyranny.
Now, the fastest that GLD ever sold off is 100 tons in 6 weeks, up to April 16th. So here in 2 weeks, just Chinese housewives or Chinese citizens have bought 300 tons. So dwarfing anything that you're seeing coming out of New York. And yet New York is trying to shout the loudest about that. Maybe Mao and his party apparatchiks said there was one farm, one collective farm that did brilliantly. Forget all those millions of others that were devastated by famine. There's this one farm. Look how great. The revolution is working.
Joe Wiesenthal is the new Mao Zedong. Mrs. Wang, the prototypical Chinese housewife, is replaced Mrs. Watanabe,
Yes,
who was
yes.
the Japanese, mythical Japanese housewife who was forcing changes in the forex market because their interest rates in Japan are so low that the housewife, who controls all the wealth in Japan, was buying, using the carry trade and other tricks to buy Australian dollars or Canadian dollars, etc. So you saw this reflected in the forex market. But now Mrs. Watanabe, just like China and Japan are now at each other's throat in a new war, Mrs. Wang is now kicking Mrs. Watanabe's butt by going out there and buying gold.
Well, it's a shift. This is a period of time change because Mrs. Watanabe, for 15 years, drove central bank policy. She drove interest rates down around the world by speculating wildly in the paper markets, selling yen, buying Icelandic krona or European euros. Now there's a new buyer in town, and they have a different mindset to what was going on in Japan. Though Japan, I might say, Mrs. Watanabe is now out buying gold as well.
Mrs. Watanabe, I salute you. And you two should get together and make peace, because you have a common enemy, Joe Wiesenthal, who's the Mao Zedong of the paper tyranny. You can beat Joe and Henry Blodgett over there at Business Insider.
Well, finally, speaking of Mrs. Watanabe, I want to show this little picture I have here of an actual kamikaze plane during World War II, and then cut to the chart of the euro on the announcement of negative interest rates. You see, this is the currency war. That's proof that the ambition is to be kamikazes.
Right, the collectivists are not shy about throwing themselves onto the fire for the ideological beliefs, rather than having the humility to simply say they were wrong. Bernanke would rather kill himself than say, I'm wrong, and as a result, gold's going to 5,000, and paper money will collapse, as all paper money has. All right, Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Stay tuned for the second half. A whole lot more. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Alasdair MacLeod, a former banker, broker, and economist who now runs the website financeandeconomics.org. His writings can also be found at goldmoney.com, where he's also director of research. Alasdair, welcome to the Keiser Report.
My pleasure, Max.
Okay, now you say that before the financial crisis of 2008, total gold ownership in the West barely rose despite tripling of prices. Talk about this.
Yes, the reason is quite simple. Just imagine there are two pots of people. You've got one pot here who values something not very much. You've got another pot here who values that same thing a lot more. What happens? It goes from there to there. That is the West, and this is the East, and that's what's been happening to gold. It's as simple as that.
Right, so you've got this migration of gold to the East, and we've seen it recently with this price drop. The prices come in, and there's huge paper selling in New York and other places. But this triggered, for the first time, a buying stampede in the East. And this is completely different than what we've seen recently, where the price declines have brought out the sellers. This is different. The price declines have brought out the buyers. Talk about what you're seeing.
Well, that's absolutely right. I think you need to draw a distinction between Western-style investors, who basically buy gold with a view to selling it at a profit. In other words, they're looking at dollars. They want to come back into dollars or sterling or whatever it is. And then on the other hand, you've got people who are worried about systemic risk, about the system maybe falling over for whatever reason they believe it's likely to happen. Now, what they do is they don't think that gold necessarily is going to go up, but they think the dollar is going to go down. So their rationale is completely different from the normal investing mentality, which, of course, is pervasive in the capital markets. Now, there is a conflict there, and this was shown very, very clearly when they bashed the price of gold and silver. All that happened is that the people who were worried about systemic risk, and bearing in mind that systemic risk has escalated considerably over the last 2 or 3 years, they came out of the woodwork and added to their positions. There is a second thing which the analysts miss. The analysts all talk in terms of annual supply, mine supply 2,700 tons, scrap another 1,200 tons, whatever the figure is. Actually, the way you should look at it is this is a 160,000 ton market. And so when some of the holders of that 160,000 tons decide that the price has fallen to a point where they want to add to their position, the effect is far larger than analysts in the cities and the capital markets generally expect.
Right, and principal amongst this misperception would be the analysis of Business Insider in New York that says when you see paper selling come into that market, they're extrapolating this as the world walking away from gold, and yet if you look in the total gold market in toto, this would be the wrong conclusion, correct?
Well, that's correct, but there are two reasons why they're wrong. Firstly is the reason that I just put forward, that actually they're analysing the small pile, not the big pile. They're looking at the tip of the iceberg, not seeing what's under the water. The second problem they've got with that is that some of the ETF liquidation could well be people deciding they don't want to have their gold stored in ETFs. They want to move it out of ETFs into something where they feel more confident they have got control over it.
Right, so that's a classic move from weak hands to strong hands.
Correct.
So now let me ask you something. You're a research analyst, head of research at goldmoney.com. Let me ask you something, because this seems to go against what I've learned in economics. The supply of gold available on the market seems to be shrinking. The mining is constrained, and the demand is incredibly high, but the prices are falling somewhat. But on the paper side of the equation, bond issuance has never been higher, trillions of dollars of bonds. Apple Computer, just to avoid paying taxes, is going to issue another $50 billion in bonds. It's more paper, but yet the price of paper has never been higher. In the U.S. and the U.K., bonds or gilts or government bonds are at 300-year highs based on increased supply. So the supply and demand doesn't work anymore? What's going on?
No, the valuation of bonds, equities, and all the rest of it is tied completely to interest rates. At the moment, it's completely to interest rates. They are ignoring, if you like, underlying fundamentals to a large extent. So it's completely driven by interest rates. And, of course, with interest rates at zero or very close to zero, there is only one way over a period of time that they can go. And that's going to be up. And the thing I think that will trigger that is that money will start to move out of capital markets into something else. Now, what that something else is, we don't know at this stage. But if it starts washing out of capital markets, then it will do so because there is if you like, a developing fear of stagflation at the least or inflation at the worst. Now, under those circumstances, once the money starts running, it could start running quite quickly. Now, we've got no idea what the timing is on that. Mr. Bernanke thinks he's got another 2 years to play with. I suspect it's going to be considerably less than that. I suspect that we're brewing up for a problem later on this year, and the zero interest rate policy could well be tested by the markets. I think it's wrong to assume that central banks always manage to control the markets. There comes a point where that control breaks down. At the moment, they've got control, but I think that's likely to go, and probably long before Mr. Bernanke would like it.
Well, the response by the holders of this 160,000 tons of gold, let's say, around the world, there's, I think, the Indian population alone has something like 20,000 tons just in the people who are buying.
At least, I would say.
At least for weddings and other things. They are victims of the paper Ponzi scheme because these low interest rates have managed to do things like move incredible amounts of money from savings accounts to speculators. So in this country alone, in the UK, they saved £70 billion on interest on mortgages with these low interest rates, but they lost over £200 billion in the savings accounts. These folks with the gold, their position now is, as we've been saying on this show, it's almost as if they're taking an aggressive position. They're looking at this as a way to fight back. The way in maybe in ancient times in Europe, they would have picked up a pitchfork or picked up a torch. They're saying, you know what, we're going to buy gold as a way to fight these banksters. And I think Nigel Farage, who's a popular politician in this country, echoes this theme as well. Is that by gilding the lily, to use a phrase there, or is that really a response?
I think you're gilding the lily a little bit, because actually what people are doing is they're trying to protect themselves. They're not out in a vendetta against whatever. They see danger. That's the point. There is an enormous amount of danger in the financial system at the moment, and people just want to have something out. But if I can go back to the Indians, can I go back to the Indians? And this illustrates the point very, very well, and why we need to understand why it is the Indians and the Chinese and all the rest of them are buying gold. An Indian who got married in 1965 would have had as his dowry, as is traditional, gold, and maybe a little bit of silver. His wife would have been given bangles and all the rest of it. Now, the cost to him of fabricated gold and to his parents, who would have contributed, at that time was around about 180 rupees an ounce. Over the years, as he produced children, he would have put more and more of his savings into gold. In other words, it is his pension pot. It's a family pension pot. Today, the price is over 95,000 rupees. There is no better performer in a weak currency than gold. That is really what has stood the test of time in India. And there are 1 billion people who, if they're not doing this, want to do this. You've got the population being unleashed in China. And so you can see, if you understand that experience, you understand that these people have not studied Keynesian economics. They have not studied Milton Friedman. As far as they're concerned, it's quite simple. We trust gold more than paper money. We reckon that gold is a better and more consistent store of value than paper money. That is our experience, and that is what we're going to continue to do.
Okay, so they're not vigilantes necessarily, but their combined buying power, it will swamp the paper because. But I got to move on because we have some issues here that I meant to bring up with you, and I'm chewing up all the time in this interview, and I want to get into these issues. Okay, you write about that there's a point in time when there's so little gold left that futures and forwards markets cease to operate effectively. So here's where this demand on the physical side meets the futures contracts, the nexus of the paper apocalypse, as I call it. But we've talked about it for years on this show. Are we at this inflection point? Will there be a failure on one of these, like the COMEX or LBMA?
Well, we will only know that by looking back at this point in time at some stage in the future. But the one thing that is clear is that whoever is involved with it, whether it's the bullion banks, well, it's certainly the bullion banks, maybe the central banks, maybe some hedge funds, the one thing they have not understood is that if you lower the price of anything, then you increase demand for it. Instead, they were working off a different mantra, the investor mantra. If a company's share price starts falling, you can spook people out of ownership of those shares because they begin to worry about whether their original assessment as to buying it was right or wrong. That is the investment approach. Actually, it's a very, very small part of the total. Now, because of that moving from one pile to another, we have a situation where there's very little left in this pile. We don't know how much, and we don't know what the exposure to it is. We know the bullion banks in London, for example, run a fractional reserve system with gold. I don't know. It could be, they could have liabilities 20, 25, maybe 30 times the actual bullion they've got in stock.
We're hearing that number as much as 100 times, 100 to 1 leverage.
Yes, that was Jeffrey Christensen, and I think more correctly what he should have said is that 100 times is the amount of fees, commission, bank interest, turns, and all the rest of it you can make out of 1 ounce of gold. I think that would be a better description of it. But there is a fractional reserve system underneath it.
Right. Well, Lehman Brothers
so
was
the
something
market's short.
Lehman was 40 to 1 before it blew up.
Yeah.
And the Fed is 50 to 1 currently.
Yes.
So they're in that range. It's highly leveraged. I want to talk about open interest. You talk in gold and silver. Open interest in gold and silver. What does this number tell us? And what do the current numbers tell us? Because this is quoted often as a number that would either validate or not validate this idea that there's some paper push smashing with naked contracts, et cetera. Alasdair, your thoughts?
Well, open interest is exactly what it says it is. It is the number of contracts in existence in any one particular commodity. So at the moment, gold is around about 420,000, a figure like that. Now, if that reduces, then what you're seeing is that overall people are having less of involvement in that contract. If it expands, then they're having more involvement. Now, the market is effectively run by bullion banks. They act as de facto market makers, if you like. And in that process, they will always run a short position. So, if there are a large number of contracts outstanding, then in general terms, it's right to say that the market-making banks have probably got a reasonably large short position, and obviously the reverse is also true. But they can close down that position basically by taking out longs rather than closing their shorts, so that on the balance, their net position, if you like, it is reduced, but the overall open interest hasn't reduced with it.
Okay, so if I dump 500 tons of gold on the market, as was done Friday gone past, and so looking at, and a lot of those naked shorts, this would be shorts that without a corresponding long, this would be more or less counterfeiting, as some would call it. Looking at open interest is not going to tell me whether or not is not a good indicator.
It's not going to tell you directly, no.
So that's not a good interest. But in your opinion, the idea is that there was this huge 500-ton position dumped in the market with the sole purpose of smashing the price, and that was the purpose of it. Are you in that camp?
Yes, I am in that camp, and what I'm not is absolutely convinced that it was a central bank, because if you bear in mind that you only need to put 5% money down, or a figure like that, something like $1 billion in margin will secure you a naked 500-ton sale. So, it could be a large hedge fund which has decided to sort of trigger the price through the floor, get all the stops running out, and then hopefully close the position at a profit.
Okay, if LIBOR is being manipulated, and the credit swap, default swap market, as we just learned, is being completely manipulated, and so why are people so resistant to the idea that gold and silver are being manipulated?
I honestly don't know. The evidence is staring us in the face.
Fair enough. All right, Alasdair MacLeod, we're out of time. Thanks so much for being on the Keiser Report.
That was my pleasure, Max.
All right, that's going to do it for this edition of the Keiser Report. I'd like to thank our guest, Alasdair MacLeod of financeandeconomics.org. If you'd like to send us an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.